Okay. Good morning. I hope you can hear me. As usual, if you are not able to hear me or there's some issue, please write in the chat box or you can speak up. Either way is fine with me. A very good morning to all of you. I'm happy to be back here with you after a gap of a few weeks. Um, we have embarked on a tax course with you on income tax, which has so far traversed areas of fundamental importance to you, starting with what is income, why that definition is important, the scheduler nature of the Indian Income Tax Act, whether it is 1961 or 2025, and the various heads of income under which we are able to understand how to recognize income. These are the areas that we did first before starting off on salary income and income from property. And today we'll be discussing business income. Income from business is what we are looking at for today's session. So you've already done so far two heads of income in some way, salary income, and then I think we briefly also mentioned income from house property in the previous session. And today we're going to go to the third head of income, which is income from business, right? And what we're trying to do is we are trying to demonstrate to you how these schedules are critical to how we understand or how we capture income under the Income Tax Act. If somebody wants to tax you on a certain kind of income, they have to go through all those provisions that talk about calculation and deductions and those kind of things under each of the heads of income, right? So that's the important point that I wanted you people to understand. That'll be helpful for you when you start thinking about income tax law in India, right? So that's where we are right now, and today we'll be talking about business income, which is the most popular head, so to speak, in the sense that anybody who's doing any business will be interested in that head because that's the schedule or the head under which their income would be taxed. So that's where we are. We're going to start off now by talking about Section 28. So, as usual, when we start talking about income under a particular head, we will have to go through the particular section that talks about it. Can I? You see, the one problem with online education is that I feel sometimes I'm speaking into a vacuum. So is it all right if one of you can just put in the chat box that the video and audio is all right, and that you're actually able to hear me and understand what I'm saying? Yeah. So if one of you could do that, I'll be grateful. Wonderful. Thank you, Dutt. Yeah. So we are. Thank you, Bana and Dutt. Thank you. Yeah. So now we are in the head business income, and my agenda for today is to take you through that head of income and say a few things about it. And if we have time, we will go to the next. We'll try and see if we have time. If we have time, we'll talk a little bit more about the next session as well. But that's if we have time. Today's agenda for me, the minimum thing that I want to do is I want to talk to you about receipts, what comes into business income and how that's taxed, right? And so, as usual, we start with some section numbers. For those of you who are not familiar with the law, including tax law, you'll notice that the starting point for all our discussions is the statute, right? So whatever proposition or claim you want to make about taxpayer rights and responsibilities, have to be anchored in a statutory provision. So if I want to say, for example, that business income is captured in a certain way, or profits of business are captured in a certain way under the Indian Income Tax Act, I need to find a provision in the Income Tax Act that supports my proposition, right? So there has to be a legal anchoring of whatever statements I want to make about any of the income that is going to be taxed. Why is this legal anchoring necessary? This legal anchoring is necessary because tax has to have a legal basis as a constitutional matter, right? So we know that under Article 265 of the Indian Constitution, um, it is laid out that the tax cannot be either imposed or collected other than the authority of the law. So there has to be an authority of the law under which tax can be imposed or collected, and that's a constitutional mandate, right? It's not a statutory mandate, it's a constitutional mandate. And if that's a constitutional mandate, it has far-reaching consequences, which is that if you want to talk about how your income is being taxed and you are laying out some propositions, you have to find support for that in a law, and in our case, in the Income Tax Act, right? So then we find that support. So the proposition for the class is that um, profits in business, profits earned by business, whatever business it might be, selling apples to selling software, whatever business it is, um, is taxed under the Income Tax Act, is captured under the Income Tax Act. How do we prove that, or how do we support that hypothesis? We support that proposition or hypothesis by looking into the act and seeing where do we find that support. And so there, then we go to Section 28 of the Indian Income Tax Act 1961. We have a similar, almost identical provision in the new Income Tax Act, which is 1925. And there the section number is Section 26, not 28. Now, before I go any further, I just want to make a few points and some logistical points that I made before, but I think it's important that we make this point very clearly, which is that all of you must have access to the statute. Um, you can have access to the statute in two ways. You can buy the Bare Act. It's available both online and offline, widely, the Indian Income Tax Act. Or you can refer to the Indian Income Tax Act online. The CBDT, the Central Board of Direct Taxes, has a pretty up-to-date and an easily accessible legislation draft on their website. So it's easily accessible. You can have that. Depends on your convenience and what you prefer. Second thing is that, as you know, Indian tax legislation is going through a transition, right? So we have the Indian Income Tax Act 1961, which is going to be transitioned out. And from next year, not from this year, but from next year, by next year, I mean from April 1st of 2026, the Indian Income Tax 2025 will be applicable. As far as you are concerned, we will test you only on the Indian Income Tax 1961. And so for your academic assessment purposes, you'll be tested on the Income Tax Act 1961. And so those are the section numbers that you should be worried about and you should be thinking about. As regards the corresponding section numbers in the new Act, I'll tell you about that from time to time, but that's only for your information, right? What you'll be tested on is, and you'll be the last batch, I suppose, that'll be tested on this, will be on the Indian Income Tax Act 1961. And remember, just because the 61 Act is relevant for two reasons. It will continue to be relevant for two reasons. One, the 2025 Act is basically in substance the same as the 1961 Act, with very little substantive changes. Section numbers have changed, the language is simpler, but principles that you see in 1961 Act will be the same in the 1925 Act. So 1925 Act does not make any drastic substantive changes to the tax legislation. So that's the first thing you need to understand, realize, and therefore what you're learning in the 1961 Act will continue to be relevant after you're learned, after the Act goes out of existence, because the same principles in a slightly different language will be applicable after that. The second thing you must realize is that um, for at least a some time, and perhaps even very many years, the 61 Act will continue to be prominent because cases which are being adjudicated today will be cases about the 1961 Act, right? And those cases will take some time to go through the courts. And so for some time, 61 Act will continue to be referred to in our judgments. I would say probably for the next 10 years at least. And so you will have, so that from that perspective as well, it's important that you understand the 1961 Act. All right. And finally, because I want to talk to you a little bit about my course and the courses that you're doing in the postgraduate diploma. The postgraduate diploma course is heavy on principles. It's an introductory uh, module on tax. It's not a comprehensive module, it's an introductory module, which means that we are introducing you to the foundations of income tax and of indirect tax and such things. And so those principles, regardless of whether it's a 61 Act or the 25 Act, will continue to play the field. Right, so keep those things in mind. But for your assessment purposes, we will be talking about the 61 Act. So let's go to the 61 Act, Section 28. I hope all of you have that in front of you. Section 28 of the 61 Act. Either you have it online or in front of you, and just see what it says. It says, it starts, the heading is profits and gains of business or profession. Right? So profits and gains of business or profession. The following income shall be chargeable to income tax under the head profits and gains of business or profession. It says business or profession. You can be selling oranges, you can be a chartered accountant, you can be a lawyer, you can be a doctor. If you're in profession as well, your professional income and your business income are under one head. The following income shall be chargeable to income tax under the head profits and gains of business or profession. The profits, and then it goes to I, clause 1, the profits and gains of any business or profession which was carried on by the SSC at any time during the previous year. That's the generic thing. And then after that, after saying the profits and gains of any business which was carried on by the SSC at any point of time, there is a series of particular items of income that may or may not be considered as income by the layman, but is deemed to be business income under the head profits and gains of business. And some of those things you can see, I'll just point out. Any compensation received when your employment is cancelled is one of them. Um, you will notice clause 4, the value of any benefit or perquisite arising from the business or the exercise of profession. Then you will notice clause VA, Section 28, Clause VA, any sum, whether received or receivable in cash or kind, for not carrying out any activity in relation to any business or for not sharing any know-how, patent, copyright, etc. So any sum received, whether received or receivable in cash or kind under an agreement for a not carrying out any activity in relation to any business. What are these in business jargon? What are these agreements usually called? Anyone? Either you can speak up or you can say it in the chat box. Um, I'm talking about 28 clause VA, any sum, whether received or receivable, in cash or kind, under an agreement for not carrying out any activity in relation to any business or profession. Yeah. Yes, that's right. These are called as non-compete agreements. Now, non-compete agreements, for a long time there was a debate whether such payments can be considered as payments coming under profits or gains of business. Some people claim these are just capital receipts. It's not revenue receipts. If I get money from you for not doing something, for not carrying out any activity, that can't be considered as a money from business activity. And if it can't be considered as money from business activity, then it can't be taxed under the head business income. It can only be taxed at all if it's under the head capital gains. But capital gains head requires a lot of hoops to jump through, like transfer of a capital asset, etc., and that may not be the case here. So those payments may just go scot-free in terms of taxation, right? So that was an issue, and finally there were some judgments that went against the revenue, and then the revenue said, let's just amend the act and deem these payments to be payments um, of a nature that comes under the head business or profits, right? So that's how this provision has come along. Okay, great. Now, what might be controversial here, right? That's a question that we are asking today. Right? It's fairly clear. If you're a trading establishment, if you're a manufacturing establishment, if you're a professional and you're earning income, you'll be taxed under the head income from business, right? But so, what might be controversial? Yeah, that's the question that we are trying to figure out today. Yeah. So, in to figure that out today, well, let's begin with a presentation. I'm going to start sharing my screen. I hope again when I do that one of you will tell me whether it's working. Yeah, so that we are sure that um, this thing is actually happening. Okay. All right. Okay. So um, one of you is going to tell me that you got business income on the screen. Yeah, just tell me. Just type it on chat box and then I'll get back to my screen. Yeah. Yes. Excellent. All right. Okay. Thank you. So business income, right? So the first thing we need to talk about business income is what's a business, right? And for that, you go to section 2, clause 13, which says that business is business includes any trade, commerce, or manufacture, or any adventure or concern in the nature of trade, commerce, or manufacture. Pretty inclusive um, definition, pretty wide definition. Section 28 says that uh, it's concerned with the taxation of profits and gains from business or profession. And the issue here would be, as a business, you may receive various things. Can all of those things that you receive be called as business income? Because only when what you receive is business income can you be taxed on it under this head, right? So we go to the first case, which is called CIT versus TV Sundaram Iyengar and Sons. And this is a case where um, deposits made by customers became time barred over the period of time. And let me explain what we mean by that. In this case, like in many other businesses, people were supplying the business was supplying things to customers. And because they were not sure whether the customers will end up paying the entire price, they were asking the customers to put a deposit to make sure that, say, you're supplying some goods to the customers, at some point of time, the customers will pay for the goods and services, but we are not sure. So then we ask the customer, give us a deposit, right? And we'll release the deposit when we receive the full payment from you. It's like how when you go and rent a place in Bangalore or any other city in India, the landlord says, well, I also need a deposit, right? So that if you don't pay your rents properly or if you damage the house, then the landlord has got access to that deposit. But of course, the problem is that many times these customers deposited money and they must have also paid up and everything was fine, but they never asked for that money back, for the deposit back, right? You'll be surprised to know that why would customers be doing it. It's actually not very uncommon in the industry. Inertia, some reason of that sort, indifference, some small deposits here and there, the customers would just not ask for it. So what then happened was that after under civil action in India, there's a limitation period beyond which you can't ask for your money back. So these deposits became time barred over a period of time due to the limitation period. And the SSC, that is TV Sundaram Iyengar and Sons, said that these deposits, we will transfer it to our general profit and loss account, and it'll become our money. Now, the question is, would it be considered as the income of the SSC or not? Right? This is when these deposits became the money of became the property of the assessee of TV Sundarmanaya's sons. Would it be captured under Section 28 of the Act as business income or not? So, what might be the answer to that question? Anybody here who might want to have a think about that? Um, Either on the chat box or or if you want to talk, that's fine as well. So only thing is, if you're raising a hand, I won't be able to see it. So okay, so Vivek, I think, said it'll be the income of the assessee, and it'll be interesting for us to understand why you might say that. So any thoughts on it? What might be the rationale for it? How does it become income of the assessee? Income of the assessee under the head business income is what I am talking about, and what might be the reason for that. Yeah, as I said, if you've raised your hand, unfortunately I'm not able to see it, so you can start talking if you want, or if you want to put it in the chat box, that's fine as well, whichever way you want. But it'll be interesting for me to know your views. Yeah. So the question I'm asking is, what makes you think that it is the income of the SSC?
Good morning, sir.
Yes, and you'll have to, sorry, you'll have to also identify yourself. Sorry. Yeah, I meant your name. Yeah. If you could just tell me your name, please. Yeah.
Vivek Kumar Sharma.
Yes, Vivek, tell me. Yeah.
Sir, as per my opinion, it is the income because it is kept in the P&L account of the SSE.
Yeah, that's interesting. So you're saying because the SSC himself has put it in the P&L account, it should be considered as coming under the head business income. Am I right?
Yes, sir.
Now, I have one question for you, Vivek. When they received the money, the deposit, at that point of time, was the deposit taxable? When they received it, not when it became time barred. When they received it, what do you think? Do you think at that point of time it would be taxable?
Yes, when he received that money, that is business income. So it is taxable.
Yeah, so that's the issue here. Actually, it is cases have held that when you receive the deposit initially, say 10 years ago, right?
Yes,
At that
yes.
time, when you receive the deposit, it's not considered as business income. It's actually a capital receipt because it's just like a security. It is not. He's not earning that deposit. In fact, the deposit is a liability because there's an obligation on the part of the business to give back the deposit money. Much like there's an obligation on the part of your landlord, if everything is all right,
At which
to
time
give
it
back.
will be income, sir?
Yeah, yeah. So the
At
problem
which
is
time
that,
it will be income.
yeah, it'll be income only at the point of time, or the question is whether it's income or not will arise only at the point of time when the deposit is time barred and when the uh, business concern has decided this is now our money. There's no liability on our part to give the money back to the customers. Thank you, Vivek, for your contribution.
Okay,
One
thank
more
you.
thing I want to say about what Vivek mentioned. Vivek made an excellent point about the fact he noticed the fact that they had transferred that deposit money to their P&L account. And he said that made a difference. That until then, the deposit was just a liability. But once the business has itself recognized that it's part of their P&L account, then it should be logically should be considered as business income under the head business. Now, and that an excellent point made by Vivek. And I just want to say underscore something there as well for the rest of the class, which is what is the again when we say something like that, when we make that proposition that if you transfer it to your P&L account, then it normally should be considered as income at that point of time under the head business income. What basis are we saying it? What is the legal basis for it? Remember that I'm hoping one of the motivations for everyone joining the tax diploma course is that it is not just merely tax, it's tax law that you're talking about, right? And tax law brings with it certain exigencies, one of which is that every proposition we make about any taxpayer right or responsibility has to be have a legal anchoring in it, right? Otherwise, it's a proposition without substance, right? So here we go. I'm going to go to the court's judgment in a second, but before that, I would like to draw all your attention to Section 145 of the Income Tax Act 1961. I repeat, Section 145. And I'm going to read out that section. Right? Section 145 says method of accounting. And it says income chargeable under the head profits and gains of business or profession or income from other sources shall subject to the provisions of subsection 2, be computed in accordance with either cash or mercantile system of accounting regularly employed by the SSC. Right? And then it says in clause 2 that the central government may notify in the official gazette from time to time income computation and disclosure standards to be followed by any class of assessees or in respect of any class of income. And what 145 is trying to say is it's trying to connect accounting principles to income tax law. It says that the way we calculate, the way we compute profits will be in accordance with the system of accounting that's regularly employed by the SSC. And Vivek's proposition that if the assessee has put it in the P&L account, it must mean, therefore, logically, that at that point of time, there is some kind of a business income recognition is supported by the proposition here in section 145. Right. And then I want to take you now. Remember, one more thing in my classes, you must have access when you're in my classes, you all must have access to the course materials that I have gathered for you, right? Including my notes, you must have it. It's on LMS. Some of you, I think, have been struggling to access it. I hope those struggles are over. You must have access to it because from time to time I will remind you about where you can read a bit more about any particular case, and it's important that all of you follow along with me when I do that. So, for example, in let's just go to CIT versus TV Sundaramayenga and Sons, note 16 of the materials. Page number is 84, but I believe that sometimes the notes and page numbers are not matching. So, note 16, page 84 in the course materials that I have with me here, and there are two paragraphs on CIT versus TV Sundaram Iyengar and Sons, and I'm going to just read those two paras out to tell you what the judgment was, and then we'll see if there's any further question that you might have. Um, Yes, so Indulekha has said for everyone that it's on page 91. So note 16 says CIT versus TV Sundaram Iyengar and Sons. Although the amounts received originally was, this is the Supreme Court talking, although the amounts received originally was not of income nature, the amounts remained with the SSA for a long period, unclaimed by the trade parties. By lapse of long time, the claim of the deposit became time barred, and the amount attained a totally different quality. It became a definite trade surplus. The principle appears to be that of an amount. If an amount is received in the course of trading transaction, even though it is not taxable in the year of receipt as being of revenue character, that is when they receive the deposit, the amount changes its character when the amount becomes the assessor's own money because of a limitation or by any other statutory or contractual right. When such a thing happens, common sense demands that the amount be treated as income of the assessee. In the present case, the money was received by the assessee in the course of carrying on his business, although it was treated as a deposit and was of a capital nature at the point of time it was received. By influx of time, the money has become the assessee's own money. What remains after the adjustment of the deposits had not been claimed by the customers. The claim of the customers have become barred by limitation. The assessee itself has treated the money as its own money and taken the amount in its profit and loss account. Right? So, and that's why they chose this to be, uh, they said that it would be captured under Section 28 as an income, as a profit of business, even though what's happening is the deposits were just being uh, being put back into the business by the assessee. Right. Great. So, any questions so far on what we have done? Anything you had you had any other thoughts on, or any chat, anything you want to say to me or ask me a question? You can, as I said, you can either raise your hand or you can put it on the chat box, and and we can chat about it. Yeah. Okay. Great. Now, this is what I want you to think about. Now, I've given you this TV Sundaram Iyengar and Sons and all of those things. Now, I have a problem question for you, which is on the screen, and I'm hoping that all of you are able to see it. Right? Um, Tell me how you will answer this question. Yeah, and don't Google, don't look at any materials. Just think about it. Just read this very slowly. Think about it, and then jot down your answers to both those questions that follow. Question one: what are the tax consequences arising from these facts for A Limited? Is actually a question which relates to not business income but business expenditure. But never mind. Let me see what you people think about it. Question two: what are the tax consequences arising from these facts for IAF? Is a question related to what we have been doing. Yeah. So think about it. I'll give you 10 minutes. 9:35. I'll come back at 9:45. Don't Google, don't look at any text. Just think about this and, of course, about what we've done so far. Just do that, and let's see if you're able to answer my question. Yep. So I'll come back 10 minutes. Okay, so shall we start? We were on the question that I gave you. Who's going to answer that question? Yeah. You can start, if you want to start talking, that's perfectly fine, but you'll have to just identify yourself, or you can uh, your message on the chat box. Yeah. So who wants to start? Surely somebody has some thoughts on it. Oh, sorry, I just realized that I probably came a minute earlier. So I'm repeating my question. So the question, let me just go over the question for you, right? And then and you tell me if somebody has any thoughts on it. A Limited, a company that invests in processed food businesses, is a 50% shareholder in Indian Agro Foods Limited, which is IAF. IAF has been set up to manufacture juice concentrates, tomato paste, and other processed fruit beverages. IAF has suffered huge losses. A rehabilitation plan was prepared by A and other shareholders of IAF. Under this plan, A agreed to waive off the principal amount of the loan provided by A to IAF, amounting to rupees 50,000. And IAF has received this loan from A to meet its expense of buying machinery. A has claimed a deduction of rupees 10. Oh, I see. That number is wrong. It should be 50,000. A has claimed a deduction of rupees 50,000 on its tax return because of the loan waiver. What are the tax consequences arising from these facts for A Limited? And what are the tax consequences arising from these facts for IAF? All right. So don't worry about what are the tax consequences arising from these facts for A Limited for the time being, because that's a question about expenditure. Let's come back. Let's go to this question. What are the tax consequences arising from these facts for IAF? Right? Interesting question, I think. And let's see who's going to answer that. I've had two answers already, one from Dutt and one from Indulekha. I'm just going to read out those answers and then we'll see if we can make sense of it. So that is saying for IAF, the loan is on account of capital for the purchase of machinery, not income. Since it is not on account of a business profession, Section 28 ITA does not apply. Since it is not a tradable receipt, Section 41 ITA should not apply. Hence, the loan waiver is tax free, but in turn, A Limited cannot claim a deduction. Okay, and then let's see. Indulekha said for A, it is a loss in business income because investing is A's business. For IAF, a capital expenditure has losses in revenue. Well, IAS, Indulekha has received something. It's not an expenditure. IAS has received something. Or well, that's the question. What has it received, right? So let me ask this question first, right? Let's go through this systematically. First question is, and then what we'll do now is this: we'll try to address this question, and and then we will see what are the cases on the point, um, and we'll go through the cases that apply to these facts. But don't worry about the cases right now. Let's just work on logic. Let's see where we are here, right? First question for the class: has IAF received an economic benefit? First question. So Sampurna is saying yes. Many other people have said yes as well. So then now the question is, if you've received an economic benefit, because you see, you had taken a loan and now you don't have to pay it back. So that is pretty much an economic benefit. And so that makes sense. But then the question, follow-up question is, will an economic benefit result in income tax, right? Particularly when we ask that question, we are not asking that question in the abstract. We are asking not that it is income, because it could be that under the wide definition of income that we have seen, Bhagwan Das case and all those other cases in the past, it is income under Section 2, Clause 24, which is the definition of income. But that doesn't satisfy that doesn't solve our problem, because income has to be captured, recognized, calculated, computed under a particular schedule, right? And so the question then is whether this benefit that a person whose loan has been waived, whether that benefit can be captured under the head business income. If it cannot be captured under the head business income, then it has to be captured under somewhere else, right? And that is problematic. Right? So let's see if it can be captured under the head business income, right? And then the question is whether it becomes a business, a profit or not, right? Um, so one way to answer this question is to ask yourself, well, Section 28 is saying a profit. This loan was taken when the loan was taken, it was taken to for a capital purpose to buy a machinery. And so when the loan was taken, it wasn't a revenue receipt, it wasn't a trading receipt, there was no tax. It's a capital receipt because a loan is a liability, you have to pay it back. If you now are able to get some benefit about it, you got a benefit, but why should it be taxed? And then somebody might come and tell you, well, we just read Sundaram Iyengar and Sons, and isn't that the case where when deposits were pretty much waived, right? When the deposits are taken over by the business, it looks to me like something equal to the customer saying, "I don't care about the deposits, you have it." And if that was considered as income, why can't a loan waiver be considered as income? So here's my next question to the class. Somebody has to answer this question. Why are we not applying Sundaram Iyengar and Sons, the case that we just did before I gave you this question, and say that this is business income? What is the difference in Sundaram Iyengar in this case that you're saying in this case it's not? So I have Dutt saying it's not. I mean, Dutt has gone far ahead and has given other sections of the act to me, which we'll come to later. But Dutt is saying it's not. So, Dutt, do you want to say why can't Sundaram Iyengar apply here? And I think Indulekha is also saying the same thing, I think. So let's start with and Vivek is saying the same thing. We just did Sundaram Iyengar and Sons, right? If that case applies, why can't it apply to this case? Yeah. Either you can speak or you can write in the chat box. Because if you want to claim, if the proposition is this is not taxable, then you'll have to defend it. And the way to defend it is to say Sundaram Iyengar, the case of Sundaram Iyengar is not applicable. But then why is it not applicable? That's the question I'm asking. Or why do you think it might not be applicable? Um, so Asha has said here it's a loan, while in the earlier case it was a deposit. True, but both deposits and loans are liabilities, right? When you receive a deposit or a loan, it's a liability. Um, and if you decide that that liability is no longer there, aren't you getting a benefit? You're gotten rid of a liability, and if you get rid of a liability, don't you think it's a benefit? Okay, before I go to that, let me see if Vivek has raised his hand. So Vivek, tell me.
So, as per my opinion, I have taken loan, but due to loss, he is unable to pay the amount. So, as per my opinion, it is not taxable because there is no profit. But in the earlier case, there was some deposit, as Asha said. So, that is taxable.
Yeah, you see, the loss is an overall loss. See, a business can be in a loss. Suppose I'm selling apples, and my overall in every year I make a loss. I'm not able to sell as many apples as I like, but that's I understand. But in the course of my business, I receive some money from customer for apples, I don't see why that's not taxable. Um, okay, Dutt, do you want to say something? Or Asha said in case of a loan, it's oh, I see. You typed your answer already. Sure. So Dutt is saying that Sundaram is about a business collecting deposits which may turn to income later. It is in the business of selling, whereas in this situation, IAF is not in the business of seeking loan waivers. It's not in the business of seeking loan waivers, I understand. Um, okay, so what you might be saying is that whatever gain, let me try to understand what that is trying to say. Whatever gain can be captured under business income has to be gain that is intimately connected to the trading or business activities of the taxpayer. In this case, in the earlier case, the deposits were intimately connected to the business or trading activities of the taxpayer, whereas in the case of in the IAF case, it's not intimately connected to the business activities of the taxpayer. You might say. Now, of course, there's a counter argument, which is that um, well, the loan was taken in order for the taxpayer to do something. It was taken to buy a capital equipment. So is it not intimately connected? And one response to that would be it might be intimately connected to buying a capital equipment, but not intimately connected to the actual trading activities, which is what I think a point was made by Dutt in his initial answer, which is correct, um, and and therefore Section 28 ITA may not will not apply. And then Datta's mentioned Section 41 ITA, which we'll go to a bit later. But let's now stick to what we are talking about. All right. So the now remember when I do these cases or these hypotheticals, sometimes students tend to ask me, "Fine, just give me the answer. Let's not worry about arguments." But actually, the journey is more important than the destination. It's important that we go through all kinds of arguments and counter arguments, and then we'll figure out if there's a solution. Sometimes there is no solution. One of the reasons why you're in the tax course at NLS is because we are giving you examples and problems where the solutions may not be easy to find, right? In this case, um, we have um, we have case law that applies here, and so let's go through that case law and see what that case law has to say, and then we will come back, right? So let's go through that case law a little bit. The just sorry, just give me 1 second. Just give me 1 second, please. Yeah, sorry, I'm back. Um, so let's go back to that to the case law, and we'll see where we are on that. The um, the case directly on point is called Iskrampco Regent Limited versus Commission of Income Tax, and they distinguished this case, the CIT versus Sundarmanga case, saying in the case of CIT versus Sundarmanga, there was a trading transaction. However, for this case, the facts are similar. A loan was taken to buy a capital equipment, and then there was a loan waiver. However, for this case, there was a waiver of a loan taken to acquire a capital asset, and therefore any loan waiver will be with respect. It's also a capital receipt. It's not a revenue receipt. It's not with respect to a trading transaction, and therefore will not come under the ambit of Section 28. 8 profits and gain from business. That's the first point that I wanted the class to note, which is there is a case on point that said that when it comes to when somebody acquires when somebody takes a loan to acquire a capital asset, say a machinery to manufacture something, and then there's a waiver of the loan with respect to that capital asset, then that waiver will not lead to business income because it's akin to a capital receipt rather than a trading receipt. And only trading or business receipts are captured under Section 28, which is a head business income. Now, this is so far as it is, but we have a complication. And the complication is that there is something called Section 28, Clause 4, which may apply, and that deals with perquisites. We are at 10 o'clock now on the clock, so we'll take a 10-minute break and we'll come back and we'll think about what that Section 28, Clause 4 is. Okay, so 10-minute break, we'll come back in 10 minutes. Thank you. Okay, so I'm back, and we can start talking about um, Section 28. Here's the issue. Section 28 of the Act says that Section 28, Clause 4 says that profits and gains of business will include the value of any benefit or perquisite arising from the business or the exercise of a profession, whether convertible into money or not, or in cash or in kind, or partly in cash and partly in kind. And it used to be the case, if you notice in your the earlier when this Escramanto case was decided, the the way Section 24 was worded was that it said clause 4, the value, clause 4 is to say the value of any benefit or perquisite, whether convertible into money or not, arising from business or the exercise of a profession. And argument in this instrumental case was that um, this 28 clause 4 will not apply. Any reason why the case might have said that? Because otherwise, you can say this is a perk, that a loan waiver is a perk or a benefit. So why can't 28 clause 4 apply here? Students, you want to say something about this? Why can't Section 28 clause 4 apply to the facts, right? And think about it from the not from the section that's in front of you, but the section that I've just read out. Suppose Section 28 clause 4 said this: the value of any benefit or perquisite, whether convertible into money or not, arising from business or the exercise of a profession. Why can't this apply to capture our loan waiver? Anyone wants to chat or speak, or write it in the chat box, please let me know. Surely you must have a thought on this, right? So you told me that the argument is that this loan was taken to buy a capital asset, so it's any loan waiver will be with respect to this capital asset, and therefore it's a capital receipt and not a trading receipt, not a business. And then in response to that, if I suppose I say no, that's fine, but remember the way Section 28 is worded. 28 starts with a general provision that says profits and gains of business are taxed. And then it actually articulates several items of income that it deems to be income, whether it's considered business income otherwise or not, it's deemed to be income. One of which, as we said, is income from non-compete agreements, but one of which is perks or perquisites, benefits or perquisites. So why can't this be termed as a benefit or a perk that you took a loan and then somebody waived it, and so you got a benefit? It's a perk or a benefit. Why can't we say that? Anyone? Any student wants to answer that question? Surely you have a response to that, right? So Vivek is saying the business expenses, so they'll be considered as income. But my question, Vivek, is specific. Um, why can't it be called a perk? That you received a perk, no? You took a loan, now you don't have to pay it back. So it's a perk, right? Now here's the way Iskram to answer this question, and we'll go back to that case, and you will see what I'm trying to get at, which is that in in Iskram the court said that that section on perquisites, section 28, clause 4, is actually applicable only to perks that are not cash or money, right? The non-monetary perks. At least that's the way it looked to them, and they saw it in an unamended form, which I'll read out again, not the one that you see currently, unamended form, which says the value of any benefit or perquisite, whether convertible into money or not, arising from business or the exercise of a profession. And they said this can't apply to monetary perks, only non-monetary. Like say you get a car from from your company, or you get some gifts from your company, or you get a gym voucher from your company, or a gym membership, that kind of stuff, but not a loan waiver, not a purely monetary benefit. That's not captured under perks. Now, that in CIT versus Ramaniyam Homes, which is a case, um, a Madras High Court case, they disagreed with that. The reasoning for Section 28, Clause 4, as per Iskrameco Regent Limited, was challenged in this case. Section 28, Clause 4 focuses on the monetary value of benefits or perquisites, whether or not they are directly convertible to money, right? And the absence of the word "the" before business in the statute broadens its scope, covering benefits arising from general business activities, not strictly the SSC's business, right? So that answers that point earlier as well. Let's just go to um, just go to note 16, back to note 16, and let's first read what Iskrameco Regent Limited said. Note 16, please. All of you, go to that note 16. There's a para I'm going to read out now. It says, in the present case on hand, admittedly, the SSC was not trading in money transactions. A grant of loan by a bank cannot be termed as a trading transaction, and it cannot also be constituted in the course of business. Indisputably, the SSC obtained the loan for the purpose of investing in its capital assets. A part of this loan amount, along with its interest, was waived by way of an agreement between the parties. Therefore, the facts involved in the present case are totally different in the facts involved from the in Commission of Income Tax versus Sundaram Iyengar and Sons, where admittedly there was a trading transaction, whereas in the present case it is not so. What has been done in the present case is a mere waiver of loan. It is only a mere waiver which has been affected by the bank in favor of the SSC. There's no change of character with regard to the original receipt, which was a capital receipt, which was capital nature, into that of a trading transaction. It is further seen that there is a market difference between a loan and a security deposit. This is something we all have discussed. But their point that it is not a perk because it's not a it's a purely monetary benefit. That point was challenged earlier. Section 28, so they continue. Section 28, Clause 4 of the Income Tax Act speaks about the benefit of perquisite received in kind. Such a benefit or perquisite received in kind other than in cash would be an income as defined under Section 2, Clause 24 of the Income Tax Act. In other words, to any transaction that involves money, Section 28, Clause 4 has got no application. Hence, we are of the view that Section 28, Clause 4 has no application whatsoever. And this was dissented to in CIT versus Ramniyam Homes, and we'll just look through that case a little bit in detail, where the court says there is one fallacy in the reasoning given in para 27.1 of the decision of this court. In para 27.1 of the decision, this court held that 28 clause 4 speaks only about a benefit of perquisite received in kind, and that therefore it would have no application to any transaction involving money. With great respect, the above reasoning does not appear to be correct in the light of the express language of Section 28, Clause 4. What is treated as income chargeable to income tax under the head profits and gains of business or profession under Section 28.4 is the value of any benefit or perquisite, whether convertible into money or not, arising from business or the exercise of a profession. Therefore, it is not the actual receipt of money, but the receipt of a benefit or perquisite, which has a monetary value, whether such benefit or perquisite is convertible into money or not, which is what is covered by Section 28, Clause 4. Say, for instance, a gift voucher is issued, enabling the holder of the voucher to have dinner in a restaurant. It is a benefit or perquisite which has a monetary value. If the holder of the voucher is entitled to transfer it to someone else for a monetary consideration, it becomes a perk convertible into money. But irrespective of whether it is convertible into money or not, it should have a monetary value so as to attract Section 28, Clause 4. A monetary transaction, in the true sense of the term, can also have that value. Any number of instances where a monetary transaction confers a benefit or perquisite that would have a value can be conceived of. There may be cases where incentives granted by the supplier, waiving a portion of the sale price, or granting a rebate or a discount of a portion of the price to be paid when the payments scheduled over a period of time are made promptly. It is needless to point out that in such instances, the prompt payment of money itself brings forth a benefit in the form of an incentive or a rebate or a discount in the price of the product. We do not know why it should not happen in the case of a waiver of a part of a loan. Therefore, 28.4 has no application to any transaction. The statement, the finding recorded, the section 28 has no application to any transaction which involves money is a sweeping statement and may not stand in the light of the express language of section 24. In our considered view, the waiver of a portion of the loan would certainly tantamount to the value of a benefit. Now, this benefit may not arise from the business of the SSC, but it certainly arises from business. And the absence of the prefix the to the word business makes a world of difference. Now, I want to say two things about this case. One is that subsequent to this case, Section 28 has been amended. Section 28, Clause 4 has been amended, and it's been made very clear now that even pure cash can be a perk. So now, Section 28, Clause 4, as it reads now, it says the value of any benefit or perquisite, this is Section 28, Clause 4, the value of any benefit or perquisite arising from business or the exercise of a profession, whether A, convertible into money or not, or B, in cash or in kind, or partly in cash and partly in kind. So now it makes it very clear. The other point that um, Ramnayam Holmes was making is a very interesting point, and I want you to spend a bit of time thinking about it. The other point that Ramnayam Holmes was making was that one might argue, it is arguable, that a perk, if it doesn't arise from the business, there is not captured under 28 clause 4. So for example, if you take a loan and it's for a capital equipment, or if you take a loan and you get a waiver, it doesn't arise from your trading activities, right? And Ramnayam appears to be saying that if it doesn't arise from trading activities, it doesn't matter because the words used in 20 clause 4 are the perks arising from business, not from the business. So as long as it's arising, because you're in business, not because it's from arising, it's related to your trade, but it's just arising by the fact that you're in business, um, makes a world of a difference. And that is actually far more it's far reaching, right? It means that even if it's not related to the trade of the SSC, it can be captured. And that's an interesting point to make. Um, let me find out at this point of time if anybody had any comments or anything to say about it. One thing I want to now, I'm going to do one more case after this, which is a Supreme Court case. So the Ramnayam Holmes and your Iskrameco and all our Madras High Court decisions, that High Court decisions. Um, but there's a Supreme Court decision on this point, and I want to say a few things about that Supreme Court decision before I close the discussion on this. But before I do that, I just want to ask you, um, is there any questions that you have in mind? Are you able to follow the discussion? Are you able to understand what's going on? So anything that you want to talk about? Um, right. Okay. So let's then move on to the Supreme Court decision in the Mahindra case. which is an interesting decision. Similar facts, right? Which is that there was somebody took a loan to buy a capital equipment, and then that loan was waived, right? So, and now the question was, in that case, the revenue said the waiver of loan was considered taxable income by the revenue department, um, because they said loan waiver amounted to cash receipts. The loan was used for acquiring capital assets, not trading liabilities, and no deduction was claimed under Section 36 for the interest paid on the loan. And consequently, the waiver does not qualify as a remission of trading liability in Section 41. But we'll come to the remission part in a bit. But let's understand what the Supreme Court said. I would like to go back. This is the Supreme Court, remember. Similar facts. Somebody took a loan to buy a capital equipment, and then that loan was waived. The question was whether that loan waiver resulted in um, in a liability or not. And I want to please go back to my course materials. And I want to take you through this case a little bit, and then I'm going to summarize the discussion we have, and then we'll see where we are on this point. So the case on point is the Commissioner of versus Mahindra and Mahindra. And I want you to go to uh, para number. I'm going to start with para number 10, right? Para number 10 of Mahindra versus Mahindra. Please read along with me. This is an important case. This case also happened before the latest amendment, which made it very clear that perks means it could be in cash as well. So let's keep that in mind. So in Mahindra versus Mahindra, the court is saying it is a well settled principle that the creditor or his successor may exercise their right of waiver unilaterally to absolve the debtor from his liability to pay. After such exercise, the debtor is deemed to be absolved from the liability of repayment of loan subject to the conditions of waiver. The waiver may be a part waiver, waiver of part of the principal or interest repayable, or the complete waiver of both, as in the loan as well as interest payments. Hence, waiver of loan by the creditor results in the debtor having extra cash in his hand, which is an economic benefit. It's a receipt in the hands of the debtor or the assessee. The short but cogent issue in the instant case arises whether waiver of loan by the creditor is taxable as a perquisite under Section 28, Clause 4 of the IT Act, or is taxable as a remission of liability under Section 41, Clause 1 of the IT Act. We'll come to Section 41(1) later. Let's just focus on Section 28, Clause 4. Now, the Supreme Court is saying the following, and please read this carefully along with me. On a plain reading of Section 28, Clause 4 of the Act, prima facie, it appears that for the applicability of the said provision, the income which can be taxed shall arise from the business or profession. It uses the word, the Supreme Court uses the word, the income should be taxed shall arise from the business or profession. Unlike what Ramniyam said, where they made a distinction between business or profession and the business or profession. Why is that distinction important? Let me repeat that idea for you. Someone might say that unless the perquisite is directly related to the business activities of the taxpayer, it is not a perk because it doesn't arise from the business or profession. So, for example, if I'm giving you a rebate because you bought so many supplies from me, that arises directly from the business or profession. But one might argue that Section 28, Clause 4 will not apply to anything that arises from business. So, for example, if I take a loan to buy a capital equipment and I don't repay that and I get a remission of that loan, that doesn't directly arise from the business activities, and therefore 28 Clause 4 should not have any impact. The Supreme Court seems to be saying in this, when it says on a plain reading of Section 28, Clause 4 of the IT Act, prima facie it appears that for the applicability of the said provision, the income which can be taxed shall arise from the business or profession. It appears to be veering towards an idea that it should be directly related to the trading activities or the business activities of the taxpayer. Also, and then it continues and says, also in order to invoke the provision of Section 28, Clause 4 of the Act, the benefit which is received has to be in some form other than in the shape of money. So it's now taking the Iskraemeco line, not the Ramaniam Holmes line. In the present case, it's a matter of record that the amount of so and so is having received as cash receipt due to the waiver of loan. Therefore, the very first condition of Section 28, Clause 4 of the Act, which says any benefit or perquisite arising from the business shall be in the form of a business benefit other than the shape of money, is not satisfied. And therefore, it can be said that the amount is not taxable. And therefore, in our circumstances, no, it's not taxable in 20 clause 4. So if you just read this paragraph, you notice that there are two parts to it, right? One part, the Supreme Court is saying it doesn't arise from business or profession, and presumably the court is saying that because this was taken to buy a capital equipment, and therefore it doesn't arise under the from business or profession. The second part is that in any case, Section 28 Clause 4 doesn't apply because it's in cash. Now, that second part of what the Supreme Court said is kind of overridden by the amendment, right? But now the amendment makes it very clear that whether it's in cash or not, it will be a perk. But the first part of what the Supreme Court is saying, which is that it should arise from the trade, not from the business, not from business, but from the business, that continues, I believe, to hold the field. So it'll be interesting to see, even post the amendment to Section 28, Clause 4, what might be the position. I mean, my take on this is that perks, it may still not be caught within the idea of perks because even a perk must arise from the business or business or trade, right? So that's my take. I wonder what you people feel about it, right? So I'm going to give you 5 minutes to absorb what I've just now said and give me an answer. And this is a question I'm going to ask you. So please listen carefully to this question. And I'm going to give you 5 minutes to organize your thoughts and tell me what you think. Here's my question. If today there's a case where you where a business bought took a loan to buy a capital equipment and then got a rebate on the loan, got a partial waiver on the loan, what would be your advice? And your client comes to you and says, well, can I've got a waiver of my loan. Is that income, business income under the Income Tax Act? What would be your answer to that question? Your client has taken a loan to buy a capital equipment, and then he has got a waiver on that loan. Your client comes to you and asks, are there any tax consequences to this waiver? What will be your answer? Yeah, 10:40. When I come back at 10:40, please have an answer for me. Yes, I'm back. In fact, I'm going to stop sharing so that we can talk to each other, and let's see where we are. Yes, so Vivek says it's not taxable because equipment and machinery are liabilities of business, and tax liability will waive off on liability. It is capital received. Yeah, it's with respect to capital equipment. Yes, Vivek, but how about the application of Section 28, Clause 4? Why is that not applicable? And anybody other than Vivek? Vivek has already spoken. Anyone other than Vivek, please? You can either write on the chat box or you can speak up. We can have a nice conversation. We have about 15 odd minutes left. So let's have a conversation about income. Yeah, and I see a number of people here. Anyone? Remember, there's no. I mean, this is for pedagogical reasons we are talking. So you can be wrong. That's not a problem. It's our our understanding of the issues is better when we are converse with each other and when we settle our doubts rather than when we are just unilaterally hearing things, right? So it's important, therefore, uh, that you express yourself. It doesn't matter whether you're right or wrong. It's part of the learning experience. Yeah. So yes, please. So who's going to tell me either chat box or even if you want to talk, that's fine as well. What is the what's the answer? Vivek says the answer is that it's not taxable. So my response to that is, Vivek, uh, let us understand the tapestry of the head business income, right? The head business income is about taxing profits and gains, but it does it in both a commonsensical manner, because one part of Section 28, the first part says profits and gains of business are taxable, but then the rest of Section 28 consists of deeming provisions, right? And they deem things. And one of the provision is Section 28, Clause 4, which says that benefits or perquisites of business are taxable, whether they are convertible into money or not, as long as they arise from business or the exercise of a profession. They're taxable. Why can't loan waivers be taxable as a perquisite or a benefit? So I have um, Indulekha responding. She says that a waiver of loan by the creditor leads to some benefit accruing, which can be considered as profits and gains from business and it's taxable. So, Indulekha, my response to that is we have got a series of cases. Um, we have got your Mahindra case and your other cases where they've said that if it is to buy a capital equipment, if the loan was taken to buy a capital equipment, then any benefit you receive from that loan will have that character, the characters of a non-trading receipt, right? It's not a trading receipt. It's not like your Sundaram Iyengar case where the deposits were taken in the course of business, not to buy anything, but or to sell any capital equipment, but to in the course of their business, right? And therefore it's not taxable. But my problem is that's the general rule, right? But the problem is that you have a Section 28 Clause 4. And how are you going to get around Section 28 Clause 4? That's the question I'm asking. Okay, so I have got Dutt, who has said, and I'm going to read out what he says. He says, the Ramaniam Holmes interpretation of business versus the business in Section 28, Clause 4 has the potential of rendering the head of capital gains meaningless. Any loan or account on account of capital will not be evaluated on its own merits. Moreover, Mahindra is currently binding judicial precedent. I would advise the character of the loan waiver is of a non-trading receipt, and hence any loan waiver would not be taxable. Very good contribution, Dutt. So let me summarize for everybody else what Dutt is trying to get at. Dutt is saying that even 28 clause 4, which is about perks, is constrained by the fact that the perk has to be with respect to a trading or business activity of the taxpayer. Even if the words used in four are different, which is the value of any benefit or perquisite arising from business instead of arising from the business, even then, the most natural business minded common sense from a point of view of a reasonable commercial person way of interpreting section 28 clause 4 is that it continues to apply to only those receipts which are intimately connected to the trade or business of the taxpayer, in which case, if you are taking a loan to buy a capital asset and you have a waiver with respect to that loan, it's not intimately connected to the trading activity or business activity of the taxpayer, and therefore should not be taxable. And he says the Ramanian interpretation is wrong. It goes against business common sense. And he says that the Mahindra case can be interpreted, as I had talked about, the Mahindra case can be interpreted as supporting the interpretation that it should arise from the trading activities. If it doesn't arise, is not directly connected with the trading activities of the business, then it cannot be considered as a perk for purposes of Section 28, Clause 4. And Mahindra case, even though it only mentioned it in one line, there's not much of a discussion on this point in the Mahindra case. It can be interpreted to support that proposition that perks must be connected intimately with the trading or business activities of the taxpayer, right? And I think that I agree with you. I think that would be my response as well. Although, as you notice, the Ramnium interpretation and then the amendment to Section 28, Clause 4 gives rise to the impression that the revenue is very keen on capturing all perks and benefits, regardless of whether they're intimately connected with the trade or business of the taxpayer. Okay, so that's where we are. Any other questions before I move on to one more point that I want to talk about before I close today? The other point I wanted to talk about was Section 41, which we haven't discussed. Section 41 of the Income Tax Act 1961 says the following. It says that, I'm going to read out Section 41 slowly. It says, Section 41, Clause 1. Where any allowance or deduction has been made in the assessment for any year in respect of loss, expenditure, or trading activity or trading liability incurred by the assessee, hereafter referred to as the first mentioned person, and subsequently during any previous year, the first mentioned person has obtained, whether in cash or any other manner whatsoever, any amount in respect of such loss or expenditure, or some benefit in respect of such trading liability by way of remission or cessation thereof, the amount obtained by such person or the value of benefit accruing to him shall be deemed to be the profits and gains of business or profession, and accordingly chargeable to Income Tax Act as the income of that previous year. Now, what this section is trying to get at, as you can see, the language is somewhat convoluted. And what this section is trying to get at is to say, you took a loan. If you have deducted something with respect to that loan, then you can't, after you get a remission of that loan, escape that deduction. Say, for example, you've taken a loan and you made some interest payments and you have deducted those interest payments from your income, and then that loan is waived. Then Section 41 will recapture that interest income because you can't get a double benefit, right? Not only are you not being taxed on the remission, but also you're able to deduct the interest payments you made on a loan that is now waived off by the taxpayer. In the Mahindra case, this question came up, but not with respect to interest payments, because in the Mahindra case, the person who took the loan never deducted any interest payments for tax purposes. But what that person did, though, and this is interesting, so listen to me carefully. What that person did, though, was that he depreciated that asset. So he took a loan, he bought some Jeeps, he depreciated those Jeeps, depreciation. And the question then was, will Section 41 come in and affect the depreciation of that as well? Will it recapture that depreciation? And please go back to your note on Mahindra. This is note 16, I think, if I'm right. Yeah, note 16. If you scroll on the Mahindra case and you come to you come to paragraph number 12, it says another important issue that arises is the applicability of Section 41, Clause 1 of the IT Act. On a perusal of the said provision, it is evident that it is a sine qua non that there should be an allowance or deduction claimed by the assessee in respect of loss, expenditure, or trading liability incurred by the assessee. Then, subsequently, during any previous year, if the creditor remits or waives any such liability, then the assessee is liable to pay tax under Section 41 of the IT Act. The objective behind this section is simple. It is made to ensure that the assessee does not get away with a double benefit, once by way of deduction and another by not being taxed on the benefit received by him in the later year with reference to deduction allowed earlier in case of remission of such liability. It is an undisputed fact that the respondent has been paying interest at 6% per annum to the lender, but the assessee has never claimed deduction for payment of interest. In the case on hand, the revenue relying on Section 41 of the Act and held that the respondent has received an amortization benefit. Amortization is an accounting term that refers to the process of allocating the cost of an asset. In this case, they bought some Jeeps, the cost of an asset over a period of time. Hence, it is nothing other than depreciation. Depreciation is a reduction in the value of an asset over time, in particular to wear and tires. Therefore, the deduction claimed by the respondent in previous assessment years was due to the depreciation of the machine, capital equipment, and not on the interest paid by it. Moreover, the purchase affected from the Kaiser Jeep Corporation is in respect of plant, machinery, and tooling equipments, Jeep related equipments, which are capital assets of the respondents. It's important to note that the said purchase amount had not been debited to the trading account or to the profit or loss account in respect of the assessment years. Hence, we deem it proper to mention that there's a difference between trading liability and other liability. Section 41 of the Act particularly deals with the remission of a trading liability. Therefore, in the instant case, a waiver of loan amounts to cessation of liability other than trading liability. Hence, we find no force in the argument of the revenue that the case of the respondent will fall under Section 41. So now it's very interesting, and I want you people to go back and read this case closely once again. I will close by saying that there were two reasons why according to the Supreme Court, Section 41 would not be applicable. Remember, Section 41 is talking about deductions taken with respect to trading liabilities. The first reason Supreme Court is saying Section 41 is not applicable is because the deductions that the Supreme Court is saying, the deductions that Section 41 is talking about, is with respect to something directly related to the trading liability. In this case, for example, interest payments. In this case, the deductions that the revenue was talking about were not interest payments, but amortization or depreciation deductions on capital equipment, which Supreme Court is saying Section 41 is not concerned about. Second thing Supreme Court is saying is that the loan that was taken was not a trading liability in the first place. It's a liability, but it's a capital liability. That loan was taken to buy capital equipment. And therefore, Section 41 should not apply because there's no trading liability in this case. Right? So these are the two interesting points about Section 41 that the Supreme Court was making. Any questions, comments, any final comments about this from the students? Vivek is asking, please give a gist of all the cases of note at the end. Yeah, what I'll do is we don't usually spoon feed the students. We expect you to read the cases on your own. But what I usually do is when I begin my sessions, I usually do a quick survey of what has happened in the past. So, for example, when I come next time, I will start talking about, I'll just give you a summary of what happened in the previous class, and at that time I will go over a brief survey of the cases. So I'll do that, Vivek. I'll give you a gist of what has happened in the cases. When I come back next week, I'll talk about that before I begin on the revenue and capital expenditure part of it. Yes, Asha, you had a question?
Yes, sir.
Yeah,
Sir, one small request.
yeah.
Our C2, that professor had told that he has given some PPTs which are flip by page, which are not in downloadable format. Although we requested him, and definitely he's very patient in hearing and all that, but he had told that to put in a word to you too in this regard, because the college the method to give a PPT flip by page. So if we are requesting that if you can kindly give it in a downloadable format, it would be easier for us to download and go through it even offline.
Sure. Is this Professor Rahul you're talking about? Who
Yeah,
is
yeah,
doing
yes.
fundamentals of
Taxation.
taxation? Yeah, I'll talk to him. Don't worry about that. Yeah, sure.
Please, sir.
Uh, sure. Thank you.
And when is our FA1 likely to be?
I mean, I think that's something that PACE department is looking into, but I'll tell them to tell you shortly. I don't have any information on that yet myself, so I think the PACE department will get in touch with you soon about that.
Okay.
Yeah.
Okay, sir. Thank you.
Great,
Thank
great, great. Yes, Indulekha said income from house property was not covered in this last session. I'll check on that. I think that when we were doing cases that distinguished between income from business and income from house property, we wanted to present some cases to you on that. But if it has not been done, we will definitely do it. I'll certainly discuss income from house property as well. Yes, somebody else had raised their hand. Yes, yes, yes.
Hello.
Ah,
Hello.
yes, yes, yes. Go on. Yeah.
Yes, sir. So my question is that when the first assessment will be happened, right, which will be of
Yes,
MCQs. So it will be
yes.
dependent on what criteria basically means.
Whatever we have learned so far in the course, we what I'll tell you what we expect from you. We expect that you come and listen to us in the classes, and you've gone through independently the cases that we have done, all those materials that we have given you. We expect that you have read those materials.
Okay. So there will be case problems or like MCQs fill in the blanks or like that.
No, I think some part of the MCQs, some part of the MCQs will be straightforward application of sections, seeking, looking at how much knowledge of tax law you got, and some parts will be some more complex application of facts. So like the problems I'm giving you here, those kind of
Okay.
problems. So some will be straightforward application of, we're just testing your knowledge, and some will be a slight more complex application to facts.
Okay. And so this marks will be added to the final assessment exam.
That's right. That's right.
Okay. Okay.
But don't worry. If you've come and listened to me in the class, you'll be in good shape. So don't worry about it.
Okay. Okay.
Yes, Vivek. We'll be talking about the previous cases before starting the current class. We'll do that. Yeah, definitely. Okay, great. So lovely talking to all of you. Have a nice weekend. I will see you. I'll see you soon. Okay. Bye. Bye.